Pablo, good to see you. How you doing? How you been? How's things, Pablo? What's up, Miles? What's up, CMF? Good to see you as well. How you doing, Kerry? How you been? Let's go. Let's go, Curtis. Good to see you as well. How you doing? Evening, Miles. Susie, good to see you as well. How you doing? Evening, Miles. Autistic, good to see you as well. How you doing? How you been? How's everyone? How's everyone's weekend? I'm hoping it was good. Okay, what I'm doing now is just pinning the chat. Pinning the live. So it's the first thing everyone gets to see. Here we go. Hello, Miles, the CMF. Scott, good to see you, brother. How you doing? Good day, Miles. Mike, good to see you, brother. How you doing? Hello, Miles. This is the final shakeout, do you think? T, I would say so, yes. The House, again, needs to win before we go into a Clarity Act, before essential regulations start kicking in, and so on. Good evening, Miles and family. Hope everything went well over the weekend, Miles. Let's go. Ian, how you doing? Hi, Miles, CMF group. How are you doing tonight? I'm doing great, Carlos. Good to see you. How you doing? Just want to clarify something. Someone thought so on Friday, when I didn't do the live show and I said a family member has passed and I'm at a family event, someone thought it was my father that's passed. No, my father is actually alive and he hasn't passed, and thank God for that, he's still alive. It was my uncle that essentially passed away. Just for clarification, for anybody that wanted to know who passed away from my family, it was one of my uncles. It was not my father. Someone thought it was my father, messaged me condolences. I thought it was my father. It's my uncle that passed away. One of my uncles passed. But I'm all okay. Now, hi, Miles. Why so much dip all the time? And when is World War 3? Johnny, good to see you. How you doing? World War 3, hopefully not. And also, regarding the dip, don't worry, Marcus will pick up again. Good evening, Miles and CMF. Manny, good to see you. How you doing? Scott, let's go. Good to see you as well. Now, before we start on tonight's live, let's do the intro disclaimer of what we're going to go from tonight's live. Because a few things have happened which everybody should know about. Some great things have happened. Some not so great things have happened, but we're going to share what we're going to talk about on tonight's live so everybody has a better understanding. Welcome to the CMF Live. If you're watching this for the first time ever, the CMF stands for Crypto Miles Family. My name is Miles. You can tune to this live Monday to Friday, 10 p.m. London time onwards for the most recent news regarding cryptocurrency, CBDCs, AI, politics, regulations, pretty much vital information for you to know about regarding the world, completely transforming into a digital space. We also do essentially Q&As on this live as well, as always, which means if you have any questions, put it down in the comment section. More than happy to help you out. Now, disclaimer of this live, as always, is not financial advice, not political advice, and whatever I say is only for entertainment purposes. Now, a lot of things have happened, which we're going to cover on tonight's live. One of them essentially being the Genius Act. Something essentially has been attached to it now. Also, we're going to talk about the government shutdown inside the US that could have some implications on why the markets are slightly dumping, and some other things that are happening around the world, which we're going to go through on tonight's live. Before we do that, and the first news is regarding the Federal Reserve we're going to cover. Let's go inside the comment section first, and then we go straight into the first news. And by the way, honestly, thank you so much to every single CMF member who has already liked and retweeted this live on X. If you're watching CMF members, thank you so much to everybody who's liked and retweeted. And thanks so much to everybody who's also liked the live if you're watching this on YouTube. If you haven't liked or retweeted this live, CMF members, please like and please retweet this live and put a comment outside the live inside the comment section, hashtag whoever you want or whatever you want. Now, let's go through the comment section before we do go through the first news. And the first, let's see where we're at inside the comment section. Sorry to hear about that loss of uncle. No, it's okay, Johnny. Thank you for that, Johnny. Scott, let's go. Condolences, Miles. Thank you so much, Susie. And share the live. Let's go, Scott. So, Federal Reserve. Now, there was something attached to the stablecoin bill, the Genius bill, essentially, that the banks didn't like, which essentially the banks were able to force the SEC in some sort of a way through the Federal Reserve to change a certain aspect of the Genius Act, which essentially is the yield. So if somebody has stable coins, they can essentially put their stable coins in, for example, Coinbase or some other platforms and earn essentially interest on their stable coins, which the banks were very scared of. Since day one, the Genius Act passed, the banks were very scared that people would take their money out of the banks and put it into USDC, for example, and essentially earn an interest on their USDC up to 3%, 4%, 6%, 7%, 9%, and so on. And that's bad for the banks. So the banks decided to put pressure on the Federal Reserve, to put pressure on the SEC, to start looking into how to change that Genius Act and essentially remove, well, the aspect of earning yield or earning interest on your stablecoins. And you can actually tell how greedy the banks are, that they are, trying to even take that little percentage that, average Joe type of person could have made on their stablecoins. The banks want to take that away from you just so they can keep on opening their doors. I mean, there's not much to say on that one. Now, Federal Reserve limits stablecoin interest in Genius Act enforcement. The Federal Reserve official, essentially Austin D, essentially announced that the Genius Act requires stablecoins to remain primarily as payment tools by imposing restrictions on interest payments, according to essentially what the reports have come out today. This underscores regulatory emphasis on maintaining stablecoins' essentially primary function as a payment instrument and only as a payment instrument, impacting stablecoin issuers like Tether and Circle, while implications for DeFi platforms and overall financial stability. The banks might be able to pressure essentially through the Federal Reserve to take away the interest on, for example, USDC or Tether on established platforms, but they're going to struggle to remove that yield part of stablecoins on DeFi platforms, to be fairly honest. The Federal Reserve official, essentially Austin D, stated that the Genius Act requires stablecoins to remain as payment tools and prohibits their use as savings vehicles with interest payments. This affects essentially fiat collateralized stablecoins like USDC, USDT, FUSD, and so on. Immediate changes include the end of the yield earning programs for stablecoins, for example. Restrictions aim to prevent digital assets from essentially acting as an unregulated deposit instrument, pushing them solely towards payment rails, and that's it. Market reactions have been muted as stablecoins essentially maintain their payment role. Major platforms, essentially exchanges, have not issued any sort of statements so far. Vitalik Buterin supports regulatory clarity, but has not commented on the specific constraints on stablecoins. And the Genius Act essential restrictions could direct crypto developments towards innovative payment solutions instead of just offering some sort of yield services. Comprehensive evaluation of the market trends suggests a pivot essentially to digital payments while maintaining financial stability and regulatory compliance. Is this a bad thing that the banks are essentially pressuring the Federal Reserve to change certain things of the Genius Act? Yes and no. The no part is, I mean, it was good. People were earning essentially yield amounts in their stable coins. And if the little guy wants to make more money, why not? The retail section person wants to make more money in the stable coins, why not? The banks should not have to say on that matter. Now, the part that's yes on this question, why it's a good thing, is because now it's all about who's got the best payment system, full stop. So between Circle and essentially Tether and Ripple and PayPal and so on, now it's only about who can offer the best payment system, full stop. Not who can offer the best yields to bring more people towards their stablecoins, to bring more people towards USDC or USDT, because the yields they're offering, now it's just about who can offer the best payment system. In that sense, well, Ripple takes the crown with RLUSD, to be fairly honest. If we're not offering yields and it's all about payment systems, well, we know Ripple always takes the crown for finance. So it's a yes or no type of scenario of, is it good news and bad news? It's both. It's bad news for the average retail person that wanted to earn something on their stablecoins. It's good news because now it's just about who's got the best payment system, not who offers the best yield services. Now, Deutsche Bank is what we're going to talk about next on tonight's slide. Deutsche Bank predicts Bitcoin in central bank reserves by 2030. Deutsche Bank forecasts central banks may include Bitcoin essentially next to gold in reserves by 2030, driven by reduced volatility and better regulations by the time we get to 2030 for Bitcoin. These predictions could essentially reshape global reserves and strategies, potentially boosting Bitcoin's legitimacy and influencing institutional liquidity and dynamics. Now, this is their perspective completely. Nobody else is having a similar perspective that 2030 by 2030 or 2030 is supposed to be the best time for banks to be more involved in Bitcoin. Deutsche Bank's report suggests that Bitcoin could become a reserve asset essentially for central banks by 2030. The analysis that the report that essentially they released today highlights decreasing volatility, increased maturity, and better regulatory essentially structures as essentially facilitators for this potential shift. Yes, facts. By the time we get to 2030, of course, we're going to be in a better place in terms of cryptocurrencies. A lot more regulations would have been established and signings and licensings and so on. Major financial institutions, including Deutsche Bank, are researching trends right now. They essentially foresee Bitcoin complementing gold, not replacing it in any sort of a way, following recent initiatives indicating that a strategic essentially diversification of reserves. Bitcoin's volatility has reached historical lows, showing essentially potential stability for use and reserves, and projections essentially indicate that its inclusion essentially as a reserve asset could boost liquidity and further cement its macroeconomic roles. The financial landscape will also likely see a gradual adaptation. Efforts to refine essentially regulatory frameworks, such as the EU's MiCA regulations, are crucial in shaping these potential essentially transformations. Deutsche Bank's analyst, essentially Deutsche Bank, said, "Our analyst indicates that regulatory momentum such as the EU markets and crypto asset legislations will enhance legal clarity essentially needed for central banks to diversify into Bitcoin." The report parallels Bitcoin's trajectory with historical gold adaptations and trends. It emphasizes essentially improvements in custody solutions and institutional readiness, vital essentially for broader financial regulations. Bitcoin's integration mirrors of that of gold in the last century, signal a macro edge essentially role institutions preparing infrastructure upgrades such as secure custody and auditing process to support this evolution. So Deutsche Bank comes out with a report today and says Bitcoin is not replacing gold, but is as good as gold for banks to be holding when they go to 2030, because the regulations will be much more established, a much more mature place, and banks should start thinking about diversifying their portfolios. I agree 100% regarding banks essentially thinking about diversifying their portfolios. Yes, 100%. However, I do believe that if banks do want to diversify their portfolio, having a basket of crypto assets is much more better than just holding one asset. I mean, it goes against everything people know about from Wall Street, which is you never put all your eggs in one basket. It's just pretty much the oldest rule they have in Wall Street, to be fairly honest. So, great idea on essentially diversifying bank accounts. Yes, banks should definitely do that. But a basket of cryptocurrencies is 10 times better than just holding one asset. And there are some brilliant assets out there. For example, alongside Bitcoin, they could be holding XRP, XLM, XDC, AVAX, Cardano, Solana, Ethereum, if they wanted to. It's just better for them to diversify. Now, Michael Saylor is who we're going to talk about next. In this downtrend inside the market space we're having right now, with the volatile space inside the market space, mainly because the House needs to win before we go into essentially the Clarity Act that's going to be coming up very soon, if the deadline doesn't get pushed in any sort of a way. Michael Saylor or any other institution right now is actually buying. This would be the worst time for anybody from the retail section to think about getting rid of their assets. Not financial advice whatsoever in any sort of a way, but we are at the stage of regulation, so don't let essentially what's happening inside the market space, put you down just because the markets are going up and down and sideways and so on, because we know where they're headed. The regulations are right around the corner. Everything's pretty much falling into line. And Michael Saylor is seeing this opportunity as a buying opportunity rather than coming out and saying, why is Bitcoin dropping to its knees, for example. Michael Saylor is doubling down again. He is essentially company MicroStrategy has just announced that the purchase of another 850 Bitcoins, spending a total of $96 million to add to its growing crypto reserves. This latest acquisition essentially cements the firm's status as the largest corporate holder of Bitcoin globally. This purchase comes at a time when Bitcoin is hovering in near its essentially recent highs, showing renowned strength essentially inside the market space. With this addition, MicroStrategy essentially total Bitcoin holdings now exceeds 158,000 BTC, worth billions of dollars. And Saylor's essentially strategy remains clear: buy Bitcoin aggressively regardless of short-term market movements. I would use the same sentence, but I wouldn't use the word Bitcoin at the beginning of it. I would preferably put XRP. Buy it aggressively regardless of short-term market events, because we know where XRP's future is headed. Again, not financial advice whatsoever. MicroStrategy's consistent Bitcoin purchases are more than just headline grabs. They reflect a broader conviction in Bitcoin as a long-term store of value. Saylor, the company's executive chairman, has long argued that Bitcoin is digital gold, a superior asset compared to fiat currencies. especially in times of inflation and economic uncertainties. This latest, essentially $96 million investment is a continuation of strategy that essentially began back in 2020, and it shows no signs of slowing down whatsoever. While many essentially institutions and players remain cautious about digital assets, Saylor continues to lead with a bold, high-stakes move, and each new Bitcoin purchased by MicroStrategy sends a powerful message to both retail and institutional investors. Confidence in Bitcoin is strong at the top. Saylor's unwavering beliefs in BTC could inspire other corporations to consider allocating part of their treasury towards crypto assets. As regulatory clarity improves and global essentially adaptations rise, essentially, large-scale investments like this one reinforces Bitcoin's legitimacy as a mainstream asset. Whether or not others follow Saylor's lead, one thing is certain: he's all in on Bitcoin. Facts. Michael Saylor is 100% all in on Bitcoin. But again, the same sentencing he used, essentially buy Bitcoin aggressively, no matter what the short-term essentially movements are. I would use the same sentence as put XRP at the beginning. Buy XRP aggressively, no matter what the short-term essentially movements are, because we know where we're heading when it comes to the XRP ledger. When the markets are down, as I've said previously, it's not a time to essentially be sad about the markets coming down and so on. And just think about it in the simplest way. How many times have you thought to yourself, I wish I brought this asset a little bit cheaper, for example? Well, times like this are opportunities, because again, you know what's going to be happening next. We're not that far off from the Clarity Act and everything else. In between, as I said a few nights ago, in between, the house needs to win. If the house doesn't win, then it's just the market going up, 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 and which means everybody puts long positions, leverage positions, 500x just for the market to go up. The market can't just go up, up, up. It needs to have some fluctuations in between. The house needs to win in between to be able to pay you out when you do trades on them. Now, moving on from that to RG Force, or essentially RG Force, becomes AVAX 1. In times like this, when the markets are up and down, one company or many companies have decided to expand into their crypto portfolios. So while some retail members might be deciding to think about selling their projects, institutions are changing company names to adapt to cryptocurrencies. For example, this company went from RG Force and now it becomes AVAX 1 in a $550 million blockchain push. RG Force Growing Systems has changed its name to AVAX 1 and plans to raise $550 million. I mean, that just shows where institutions are standing at right now, where they're willing to change their company, their public company name, just to be a part of the blockchain space. So this is why I say it's the worst time to sell. It's the best time to hold or buy if you can. Not financial advice whatsoever at all. Everything I say is for only entertainment purposes. Now, the company essentially confirmed the transition on X, highlighting essentially HiveMind Capital as the lead partner. Additionally, the Streak essentially advisory board will include essentially Anthony from Skybridge Capital and Brett from essentially Coinbase Institutional. As per the announcement, AVAX 1 strategy targets ownership of more than $700 million worth of AVAX tokens. The plan begins with a $300 million essentially PIP offering, suggesting essentially subject to shareholder approval. Moreover, additional essentially equity-linked raises could generate another $250 million. Hence, the company expects to become a foundational partner in AVAX's essentially expanding ecosystem. AVAX is a brilliant project. I said this a long time ago as well. CEO essentially Julia stressed the significance of this pivot. For the first time, our company provides public market investors with professionally managed vehicles to invest directly in this transformation, she said. Besides, she noted that the mission focuses on delivering direct value to shareholders as the new economy grows. HiveMind Capital founder, essentially Matt, nominated as chairman, described the vision clearly. Our vision is to build the Berkshire Hathaway of the essentially on-chain financial economy. He explained, the near-term focus will remain disciplined AVAX accumulation only. However, in the long run, AVAX 1 will onboard fintech businesses onto AVAX essentially Avalanche, creating a sustainable growth engine. He also, essentially Anthony, also reinforced this shift by saying the tokenization of assets is the single biggest theme for the next decade of finance. He said, moreover, he called AVAX 1 essential on-ramp for public investors. As a result, the announcement essentially of RG stock surged 128.63%, closing at $5.51 essentially cents, according to Yahoo Finance. AVAX 1 is giving everyday investors on Wall Street a clear path to tap into AVAX's blockchain network. It's brilliant to see when essentially institutions adapt so much to cryptocurrencies, because it doesn't just bring credibility for AVAX, but it brings credibility towards the crypto space from where it was, which was a Ponzi scheme, to now companies, public companies, changing their company name just to be relevant for the next essentially, future we're heading towards, which is all about digital currencies and tokenizations and CBDCs and so on. Now, before we go through the next news on tonight's live, let's go inside the comment section first. As I said previously, this is live, as always, not financial advice. As I said, this is live, as always. If you do have any comments, put it down inside the comment section. More than happy to help you out. So let's see where we were at inside the comment section. Good evening. Good evening, Miles and all CMF. Share the live if you can. Let's go, JP. Miles, some guy talks about numerology, says big dip in 2026. A lot of people say a lot of things. Just stick to the facts. Everybody has an opinion, but opinions are not facts, and facts are facts. Miles, some guy talks, good evening, Miles. Kali, good to see you. How you doing? Morning, Miles and CMF. Shelly, good to see you. How you doing? Can you earn from crypto without interest? Without interest, can you earn? Sure, you can stake your crypto assets because they're not focused on cryptocurrency. They're more focused on stable coins, essentially from yield bearings, not crypto. So you can still earn on your cryptocurrencies. Good evening, brother Miles and the rest of the family. Good to see you all, funky brother. How you doing, CMF? Let's go. Hi, brother Kamal. Good to see you all. How you doing, guys? I've missed much, funky brother. A bit. You've missed a bit. Good evening, Miles. Michael, good to see you. How you doing? How you doing? I'm doing great today. Happy Pisces. Good to see you. How you doing? Let's go, CMF. Time is running out. Facts. Tension sick. Time is ticking. Facts. Hi, Miles and CMF. Comatose. Good to see you. How you doing? What's your thoughts? What's your thoughts on Epic token? I haven't really looked into it, so I would have to look into it, give you a better perspective. Michael, put a comment outside the live, and I'll reply back to your comment on YouTube. What up, Miles and CMF? Ray, good to see you, brother. How you doing? Hi, Miles. Richard, good to see you. How you doing? Good evening, Miles and all CMF. Adi, good to see you. How you doing? Please like the live and retweet. Let's go, funky brother. Evening, Miles and CMF. How was your weekend? It was good. Joe, good to see you. How you doing? How was your weekend? Now, critical statements from the Fed member Bostic. This also had a role to play on today's market downtrend, which was, this is what he said. There will be no more rate cuts this year, and here is why. The Atlanta Fed president, essentially Bostic, remains cautious about rate cuts and inflation concerns. The Wall Street Journal reported, speaking to the Wall Street Journal, Bostic essentially said he expects only for essentially one rate cut to be happening in 2025, which it already happened. Bostic said the Fed essentially is hesitant to support further interest rate cuts in October due to inflation running above its 2% target. He noted that despite essentially economic risk shifting towards weak employment, he currently expects only one rate cut in 2025. He said, I'm concerned about inflation, which has been too high for too long. So I won't take action or support it anymore, but we'll see what happens. Bostic said the latest rate cut in September was reasonable. The rate cut should have been around 50, but 0.25, but uncertainty remains high. At this point, Bostic essentially stated that in 2025, inflation forecast will be at 2.9% and a core inflation will be at 3.1%, and said he does not believe inflation will fall to 2% target probably until early 2028. He warned that tariffs and immigration restrictions could slow labor force growth and maintain moderate price pressures. He said that the current policy essentially environment is one of the most challenging, with risk to both inflation and growth increasing. So according to the Fed, essentially, this was pretty much the only rate cut we're ever going to have. Now, regarding the rate cut, essentially timetable, as I said previously, day 1, mute, day 2 to 3, a little bit happens in terms of readjusting liquidity, which we had a little burst between Thursday and Friday. Now, the biggest burst will come between the space of 2 to 7 weeks after a rate cut. Even though this was our early rate cut, after 2 to 7 weeks is when we're going to see that burst inside the market space after essentially rate cuts. Now, moving on. That had a small percentage to play inside the market space today, but this one also had something to play, which is why the markets were also a little bit down today. Democrats back a baptism plan to reform market structure bill. A group of Democratic senators inside the United States Congress has expressed their openness to working alongside Republicans to develop. Sorry, this one is actually very positive for cryptocurrencies. It's another Democratic news that we're going to go through on tonight's line that's a bit negative. This was actually very positive. A group of Democratic senators inside the United States Congress has expressed their openness to working alongside Republicans to develop a comprehensive framework for digital asset market spaces. In a joint statement released, essentially, 12 senators, including members of the Senate Banking and Senate Agriculture Committees, emphasized their support for baptism efforts to establish clear regulations for cryptocurrencies and blockchain-based assets. Democrats are actually coming around. They're coming around towards crypto, essentially, innovation inside the United States. They want to, be alongside Republicans and pass things through. Brilliant. Before, Democrats wanted to give some input, bad idea. Now they just want to be a part of it and pass it through. Excellent, because we're coming up to the Clarity Act. This is what essentially was said. We hope our Republican colleagues will agree to a baptism, essentially, authorship process as in the norms of legislations of this scale, the senator stated. Given our shared interest in moving forward quickly on this issue, we look forward to collaborating on reasonable proposals to shape the future of crypto regulations. Despite Republicans holding a majority in both chambers, they may still require some Democratic support to pass the legislation through. Among the Democrats proposed 7 key pillars for digital asset essential market to combat illicit finance and address the gap in the support of the market for assets not classified as securities. They further essentially urged Republican backing for initiatives aimed at essentially preventing corruption and abuse within the crypto sector. Fair enough. You know who didn't sign it from the Democratic Party? Who didn't sign for crypto innovation inside the United States? I mean, it's no surprise. As usual, Pocahontas. She tends to stand on the other side of innovation, on the other side of everything. So, interestingly, Massachusetts Senator Elizabeth Warren, a prominent Democrat on the Banking Committee, chose not to sign, essentially, the joint statement between the Republicans and the Democrats coming together for crypto innovation. Decided not to sign it. No surprise there. During the August recess, she voiced her stance in an interview that while digital assets requires regulations, she would not support legislation essentially perceived as being heavily influenced by the crypto industry. Because the only people that know crypto is the crypto industry. So maybe their opinion is a lot more valuable. Maybe Ripple's opinion, Coinbase's opinion, Binance's, Crypto.com's opinion is a lot more valuable than what essentially Elizabeth Warren has to say, because she knows nothing about the blockchain space and they do. So maybe their opinion is more valuable. But again, it's Elizabeth Warren. She thinks only, her opinion matters, her voice matters, and so on. And she does believe that she is a lot more essentially intelligent than all of those companies inside the blockchain space put together, because she thinks she understands this market space perfectly. Meanwhile, recent discussions between industry leaders, essentially Republican lawmakers, suggest a strict push to advance crypto regulations. Coinbase's CEO Brian Armstrong and other executives met with GOP representatives to explore legislative paths for integrating cryptocurrencies into the broader financial systems. Although the House of Representatives passed this version of the market structure bill under the Clarity Act back in July, Senate Republicans are drafting a separate bill aimed at creating a robust regulatory environment for cryptocurrencies, dubbed the Responsible Financial Innovation Act. This legislation is expected to undergo hearings in the Senate Banking Committee and Agriculture Committees before essentially a possible vote by essentially the end of this year, with Senator Luminous confirming the timetables. As the US approaches a critical juncture in crypto essentially regulations, industry essentially insiders remain optimistic about establishing a clear and supportive legislative framework by 2026, positioning the United States as a leading hub for blockchain innovation, DeFi, and NFTs. So, some Democrats are coming forward. 12 Democrats, in fact, came forward and said they'll join the Republican Party on bringing crypto essentially innovation back to the US. Brilliant. The rest of the Democrats couldn't care less, and Elizabeth Warren didn't even bother signing it. But again, honestly, it's no surprise there. Now, either way, we're going to pass through because we have the majority, which is the Republicans, and 12 Democrats on top. Beautiful. We'll pretty much pass anything through for the crypto sector. We don't really need Pocahontas' opinion or her votes, to be fairly honest. Now, something we talked about on last week's live show, which was regarding Russia, and essentially how Russia's Putin advisor came forward, Anton, and said the US is maybe using stablecoins to essentially, get rid of their debt, to dissolve their debt. using stablecoins or using some sort of the blockchain sector to dissolve that debt. Since that day, China has made it very clear to Hong Kong that they don't want to be involved in stablecoin regulations. Very odd. Before that, China didn't, say much, but they were starting to look pro towards cryptocurrencies because the US passed a bill and regulations, and every country was putting their input in. Hong Kong was moving quite fast towards stablecoin regulations due to the Genius Act being passed, and so many of the countries were getting involved in terms of, if they had a stablecoin regulation. If they didn't, they were just amending it or bringing a new one in. And since that day, Anton, Putin's advisor, came out and said the US might be using blockchain to get rid of their debt, which means the US will go back to number one, even though it's still at number one. But even in a digital world, the US will still be number one, which is something that China hates. China wants to be number one. You can tell that from a mile away since the day they created BRICS. And since that day, Anton came out and said that, the very next day, Hong Kong comes out with the news that China told Hong Kong to not let Chinese businesses get involved in stablecoins because they think the US might be using stablecoins to dissolve their debt. Interesting enough, Hong Kong essentially has been pressured once again from China, but regarding tokenization this time, because they know the US is also very big on the idea of tokenization, and some of the biggest blockchain companies out there are American-based regarding tokenization. So here's what's come up. China pushes to suspend real-world asset tokenization initiatives. China's securities regulator, the China Essentially Securities Regulation Commission, CSRC, has advised leading brokerage essentially in Hong Kong to pause their real-world asset tokenization initiatives. Now, that's just for Chinese firms in Hong Kong, not for international firms in Hong Kong to stop essentially real-world asset essentially legislations and licensing and so on. Just for the Chinese businesses, they can't get involved in tokenization or stablecoins for now. According to the retainers report that came out today, this advice essentially aims to enhance risk essentially management and ensure the actual operational abilities back essentially any business claims. The CSRC recommendation reflects a careful approach to regulations as interest in blockchain-based asset tokenization grows, especially in Hong Kong. While this pause does not mean a total ban, it creates an uncertainty about when major financial institutions will issue real-world asset tokens in the future. They're playing it off as, China's moving cautious in this essentially world of cryptocurrencies. I call BS because Anton comes out and says the US might be using stablecoins to get rid of its debt. China comes out the next day and tells Hong Kong, don't let Chinese firms get involved in stablecoins. You fast forward to Monday, China comes out and tells Hong Kong, don't get involved in tokenization because they know the US is all in on tokenization. And the entire Wall Street is all in on tokenization right now. Notably, the CSA has reached out to two major brokerage, essentially firms, although their names were essentially not shared publicly. It remains unclear whether the regulator will extend this guidance to more firms or if this is just a temporary step as a part of a larger regulatory reviews. Despite the regulations essentially in place, experts believe real-world asset tokenization has brought essentially a bright future towards Hong Kong. The city is actively rolling out policies to attract blockchain companies, international blockchain companies, while strengthening its position as a leading digital asset hub in Asia. It is worth noting that Hong Kong has rolled out its essentially latest digital asset policy blueprint. This placed essentially a strong emphasis on stablecoin oversight and tokenization of real-world assets. As reported, essentially, the framework dubbed LEAP focused essentially on 4 pillars: legal, clarity, ecosystem development, application of real-world use cases, and the promotion of talent. The government also reviewed plans to institutionalize tokenized government bonds and issuance and encourage the development of tokenized ETFs. Hong Kong's vision essentially stretches beyond traditional finance. Even though China is telling them, don't work with Chinese companies for now until we figure some stuff out, Hong Kong is still moving forward with international blockchain firms. The policy advocates expanding tokenization in areas such as renewable energy and precious metals like gold. It's a brilliant idea. There is no doubt that Chinese government officials are now paying more attention to stablecoins and real-world assets. Is it because of the US? Probably yes, because they're the #1 rivals. Some government officials have begun to explore how these tools can be essentially utilized to support financial innovation, enhance payment systems, and foster the digital economy. This suggests that while China remains essentially cautious about cryptocurrencies and essentially about cryptocurrencies, the country is not completely closing the door on blockchain and digital assets yet. They're just putting a pause. Recall that essentially recently, several social media posts claimed that China had placed a new ban on crypto trading and mining. However, experts, essentially trusted sources, came forward to confirm that these claims were false. China hasn't banned cryptocurrencies whatsoever. There is still some Bitcoin mining actually going on in China, so there's not a full-on ban, and it was never a full-on ban. It's just bigger corporations had to move. The smaller ones, they can still mine. There are some provinces in China where you can still mine Bitcoin, even the day that they announced the ban of Bitcoin. But seems like China is tiptoeing inside the crypto space, pausing stablecoins, since what Anton said, and then also pausing real-world assets straight after. But again, this is just for Chinese firms. I mean, this is a bad play for China. It's only going to end bad for them because they'll be left behind even further. As essentially the US, the biggest market space on the planet, just goes full frontal towards stablecoins and stablecoin regulations and tokenizations and real assets and so on. You know, this is just bad for China because they'll be joining the game too late. But let's just see how essentially, Xi Jinping is going to get pressured from Chinese firms or Chinese banks, because they have been pressuring the Chinese government to get more involved inside the crypto sector. So let's see who's going to win that battle, the Chinese companies and banks or Xi Jinping. Now, Bitcoin essentially has declined in terms of spores of gold rally in the safe haven demand. Now, there's some news essentially that's come out regarding essentially Bitcoin's footsteps, how it might be not essentially comparable to gold as they might have thought it was. Now, there are two reports. This one is essentially more on the side of BlackRock. Morgan Stanley also came out with a report today as well, which we're going to go a little bit further on tonight's live. But here it is. This is the first one. Bitcoin essentially declined spurs a gold rally aimed at safe haven demand. So as gold is surging, Bitcoin is not so much. This trend essentially highlights the strict move towards that gold safe haven status affecting Bitcoin's markets, influenced by institutional reallocation and decisions reflecting evolving risk perceptions. It also seems like that BlackRock has essentially expanded their gold portfolio. Bitcoin's drop and gold rise demonstrates a capital rotation into traditional safe havens. Is this the start of massive corporations shifting from the digital gold to the actual gold? Maybe not, maybe yes. This trend reflects an institutional investors responding to perceived global economic threats. Institutional assets rebalancing their contributed significantly to this observable essentially market regime shift. Major asset managers like BlackRock have increased their gold exposure in their recent portfolio. They have capped their Bitcoin allocations ever so slightly. Analysts suggest that this may essentially indicate a long-term shift towards gold as the preferred asset than the digital gold. The immediate effect of this shift indicates a higher demand for gold, while Bitcoin sees a decline year-to-date performance. This trend essentially suggests that differing investor sentiments, with Bitcoin aligning more with the risk asset. Ted, essentially Pillows, the market analyst, he said, gold's ongoing rally provides the framework for understanding Bitcoin's market structure. If gold keeps breaking records, Bitcoin is poised for a similar, although currently lagging in terms of a breakout. The implications for financial essentially markets include increased gold purchases by central banks and other major institutions. Bitcoin's volatility is influenced by regulatory uncertainty, aligning more closely with the equity markets than a traditional safe haven. Interesting enough, Bitcoin was named as the golden goose. Now it's just a goose. The negative correlation between Bitcoin and gold is the recent development. You know how for the longest time I've been coming out and saying that, for example, Michael Saylor, he would call Bitcoin digital gold. And a lot of people inside the crypto space would come out and say Bitcoin is digital gold, or a safe haven, or a risk-off asset. And I've always said, if a war breaks out between two countries randomly, let's say China attacks Taiwan tonight, what's going to happen to the price of Bitcoin? It will go down. What's going to happen to the price of gold? It's going to go up. But aren't they both risk-off assets? Isn't Bitcoin and gold gold? Basically, one is gold and one's digital gold? Because they're not. I've said this for the longest time. The idea of calling Bitcoin digital gold when it doesn't react like gold, it's a bit odd. And this is what's essentially coming out today. So market analysts forecast that Bitcoin may follow gold's upward trajectory, if trends continue. However, Bitcoin's alignment with equities during macroeconomic volatility challenges its safe haven status that it has right now, prompting debates on future market dynamics. They're having second thoughts about the whole Bitcoin safe haven digital gold title they've been giving it for the longest time. Seems like, honestly, their golden goose is no longer laying golden eggs, just eggs. Now, moving on from that and I do have another report, which is from Morgan Stanley on Bitcoin's future to come. But before we talk about that, let's talk about the US and the UK for now, because we had that big US and UK event, which we talked about essentially on Thursday's live show. But some things that everybody should know about, some things that even happened behind the scenes. So, the US and the UK authorities launched the Digital Asset Task Force to boost crypto oversight today. In a move that to foster closer cooperation on digital assets, authorities from the United States and the United Kingdom have announced the launch essentially of their new transatlantic essentially task force dedicated to exploring collaborations on cryptocurrency regulations and innovative digital essentially markets. Both the US Treasury essentially Department and the essentially HIM Treasury disclosed the initiative via official notices essentially today. The effort, which builds on the existing UK and US Financial Regulatory Working Group, aims to essentially produce a comprehensive report within 6 months. The new body, named the Transatlantic Essentially Task Force for Markets of the Future, they're naming it, will examine key issues related to crypto laws, regulations, and the development of a wholesale digital markets. The announcement essentially follows recent reports of high-level meeting between UK Chancellor Rachel Reeves and the US essentially Treasury Secretary Scott Bessent. The discussions focused on deepening collaborations on crypto regulations and may include insights from several leading industries and players, with the task force emphasizing the importance of industry inputs for informed policy essentially developments. While the US Treasury essentially did not explicitly link the new task force to specific legislations, it's notable that Congress is advocating for frameworks, including Genius Act, designed to establish regulations for stablecoins, signed into law in July. And this law essentially requires the Treasury to work alongside Federal Reserve to craft appropriate regulations for crypto assets. Coinbase expressed strong support for the initiative between the UK and the US coming together, highlighting its commitment to strengthening US and UK digital market ties. Daniel from Coinbase, essentially Vice President for Europe, Middle East, and Africa, participated in the discussions between Reeves and Bessent, underlying essentially the industry's active role in shaping regulatory pathways. Both nations have taken steps in 2023 that suggest a desire essentially to shape the evolving essentially crypto landscape. Now, fast forward to 2025, the UK government has signaled a balanced approach aiming to promote innovation while combating fraud, as Prime Minister Keir Starmer, who is not very popular, and other officials explore essentially policy frameworks. In contrast, the US regulators under Secretary Essentially Bessent have shown an essentially inclination towards more permissive essentially or scaled back regulations, with recent discussions around potential government-backed acquisitions as a part of a crypto reserve. These developments point to a shared recognition of transformative potential of blockchain technology, cryptocurrencies like Bitcoin and Ethereum and XRP, and the broader cryptocurrency market space, even aimed deferring regulatory essential philosophies as the US and the UK continue to engage in the future of global crypto regulations, and may increasingly reflect the collaborative efforts focused on fostering innovation while ensuring market stability. It's honestly brilliant to see the UK is, taking these, finally taking steps in the positive side towards cryptocurrencies and following Donald Trump's footsteps, because the man knows what he's doing. He's a businessman, and he has helped America quite a bit. As much as people might hate on him, he has helped the crypto space tremendously, to be fairly honest. And then on that note, regarding essentially Donald Trump, I just want to point out one thing. There was also another thing that was happening. Behind closed doors, Coinbase and Ripple had a conversation with Keir Starmer at number 10 Downing Street with the Prime Minister of the United Kingdom. They had a meeting with him behind closed doors. We don't know what Ripple or Coinbase discussed with the Prime Minister of essentially the UK, but I'm guessing it's all about the future of the UK. And it's good to see that Ripple was essentially sitting at that table with Keir Starmer. Now, moving off essentially the UK and the US. Two, US lawmakers pushing essentially the SEC to enforce the Trump order, opening a $12.5 trillion market space for 401k markets to crypto. So, President Trump essentially wants to implement the idea of people being able to put their 401ks into cryptocurrencies. A $12.5 trillion market space. Brilliant idea. That provides so much credibility towards the crypto space for even 401ks to be on them, but also provides a tremendous amount of liquidity. Implement President Donald Trump's executive order aimed at allowing cryptocurrencies and other alternatives into 401ks and retirement plans. The order, essentially signed in August, directs regulators to modernize rules that have traditionally restricted retirement savers from investing in alternative assets. Now, there are some jurisdictions essentially that do offer that type of service of 401ks going towards crypto assets, but not everywhere. And Donald Trump wants to open the floodgates for everywhere. For 401ks, if you want the option, you can put them towards cryptocurrencies. So, officially titled, essentially access to alternative assets for 401ks in investors, the order instructs the Department of Labor and the SEC to explore ways to include crypto, private equity, real estate, commodities, and infrastructure investments in employer-sponsored retirement plans. The DOL essentially has been given 180 days to review existing guidance and clarify how financials can offer these investments while staying within the legal and risk management standards. The order essentially also calls for the creation of a safe harbor protections for plan sponsors and to encourage broader adoption of the market space. Supporters in Congress have praised the order, saying it modernizes the retirement system and gives American workers more flexibility in how they invest in their savings. And critics, however, warn that exposing retirement funds to volatile assets such as cryptocurrencies can increase their risk of reduced transparency and complicate oversight. I don't think those critics understand what cryptocurrencies are, because cryptocurrencies are actually transparent. Because if I had to take a guess, I don't think they're going to be offering 401k members to put their assets into Monero or so on, or any sort of other private, stable, any other private cryptocurrencies. They're probably going to be offering the 401k members Bitcoin, Ethereum, XRP, Solana, Cardano, or HBOT, and so on. They're not going to be offering the Monero, are they? So the idea of calling this a bad idea, the critics calling this a bad idea, 401ks and cryptocurrencies, because they're not transparent. Yes, they are. And especially if your 401k account is connected to it, then there you go. That's your full KYC. The US defined contribution, retirement market, including the 401k plans, manages an estimated $12.5 trillion in savings, much of it traditionally invested in stocks, bonds, and cash. If implemented, the new framework could open the door for millions of Americans to allocate a portion of their retirement funds to digital assets and other alternatives, potentially reshaping the retirement investment landscape. That's a brilliant idea, but they're essentially pushing the SEC to greenlight this project for $12.5 trillion to enter the crypto market space. That is big. On two things, as I said. One, credibility. That adds an immense amount of credibility towards the blockchain space, because if the US does this, then more countries are inclined to do the same thing. Brazil will follow its footsteps. South Korea will follow its footsteps. Hong Kong will follow its footsteps. Dubai will follow its footsteps. The UK, now they're partners with the US, will follow the US's footsteps. So more and more countries will essentially be opening their doors to 401ks, alternative 401ks, pension funds, and so on, towards cryptocurrencies. That means, again, more essential credibility because of what the US was going to be doing once it's passed through, and a tremendous amount of liquidity for the blockchain space, depending on which crypto projects are chosen. Now, in both ways, it will add indirect and direct value, depending on the asset that's chosen. The ones that aren't chosen, it will still add indirect value, top 10, top 20, top 30 projects, and so on. Now, moving on from that to the UAE. Before we talk about the UAE, let's go to the comment section first, and then we go straight into the next news on Tonight's Live. Let's see where we're at. Richard, good to see you. How you doing? Good evening, Miles, and all CMF. Adi, good to see you. How you doing? Please like the live and retweet facts. Let's go, funky brother. CMF members, if you haven't already liked or retweeted this live, like and retweet it on X. If you watch us on YouTube, just drop a like and drop a comment outside the live also. Evening, Miles and CMF, how was your weekend? That's good, Joe. It's good. How's yours? AVAX doing well for itself nowadays. Let's go. Facts. AVAX is doing very well for itself. Hi, Miles and CMF. Peg, good to see you as well. How you doing? Shall I say, CMF members, please promote the live by liking, reposting, and placing a comment outside the live. It's very important that CMF members put a comment outside the live, inside the comment section, outside the live. Very important because it helps with the algorithm quite a lot. There is a lot of you in here. Essentially, this is the best way to show support for Miles Facts. If you want to show support to the CMF lives, if you want to show support to me, the best way to do it is by liking and retweeting only. Like, retweet, and put a comment outside the live. If you enjoy these live shows that I do, and now we're on episode 377. Episode 377 is where we're at right now. If you enjoy these live shows, if you're entertained by these live shows, if you're learning from these live shows, and you want to show support, just drop a like and essentially a retweet and put a comment outside the live. That's how you show support for what I do. If you have done that, and if you've done that for every live show, thank you so much. If you haven't, stop doing it. I don't understand why you wouldn't do it. Now, if you're learning from these live shows and you're educated from these live shows, and if you want to show support, that's the way to do it. Now, UAE is what we're going to talk about next. UAE joins OECD crypto tax framework. This is an interesting one. And this is something everybody should know about inside the crypto space, which is that Dubai is about to be joining a framework for other countries that are also involved in, where countries are going to be starting to share tax information. So if you were somebody that, thought about maybe escaping to another country with your big crypto wallet to skip on taxes maybe, well, countries are about to be sharing tax information with each other. So if you do go spending in, for example, Dubai now trying to join this framework, essentially the United Arab Emirates now joining this framework, is working with any other country within this framework, and they're going to be sharing your tax information. So if you have been skipping on taxes and you're thinking about flooding to Dubai, maybe think twice. In a major step towards international financial cooperation, the United Arab Emirates, the UAE, has officially joined the OECD's crypto asset reporting framework, CARF. Do you know who also this is bad for? But good in my way. Essentially, I see it as a good thing, but do you know who essentially this is bad for? All the crypto scammers. Dubai has always been the hotspot for crypto scammers, because crypto scammers will pull a few scams wherever they are around the world, and when they make enough money, they always fled to Dubai as a safe harbor because nobody can reach them. Well, things are about to be changing because Dubai is about to be snitching on everybody in Dubai who uses crypto assets, and all of your tax information is going to be shared. So starting in 2028, the UAE will begin automatic exchange of crypto-related tax data with other CARF member countries. This includes information about crypto transactions, user identities, wallet holdings, transfers and collected from crypto service providers in the UAE. If you're using Dubai crypto exchanges, thinking you're off-grid, all that data has been stored in that essentially platform and is going to be shared by 2028 with other countries around the world. So every country knows how much you've been spending in terms of cryptocurrencies, where are you hiding your cryptocurrencies, how much are you holding in terms of cryptocurrencies, and what platforms you use. That data is going to be shared. The Crypto Asset Reporting Framework, CARF, was developed essentially by Organization for Economic Cooperation and Development, the OECD, to close the gaps in crypto tax reporting across jurisdictions, so that scammers don't pull a crypto scam here or tax dodgers and then fly over to Dubai and essentially spend their stolen crypto money from hardworking people. By joining CARF, the UAE is committing to ensure that crypto assets are no longer a blind spot in international tax enforcement. This includes working closely with other governments to share verified user data, reducing the risk of tax evasion and illicit financial activity. For individuals and companies operating in the UAE, this move will require greater compliance with tax reporting obligations. Crypto exchanges wallet providers and custodians will need to implement more robust KYC and reporting systems by the time the framework goes live in 2028. So you have until now, till 2028, essentially, for Dubai to implement, for the United Arab Emirates to implement the system across the other countries that are also a part of CAF. So 2028 is basically your timeline of all that data is going to be shared with other countries, depending if they're in the CAF. However, this isn't necessarily bad news for the industry, because it really isn't. Closing blind spots and closing gray areas is what essentially makes the crypto market space more structural, for example, more foundational, rather than a gray area where scammers get to, essentially steal from work-hardened people and flee to other countries to spend their stolen crypto money from regular folks. This will close that market space so that scammers inside the crypto space will think twice about pulling a meme coin pump and dump scam and then running off to Dubai or running off to anywhere pretty much around the world, which then will close so many gaps inside the crypto space. I will make the crypto space much more a mature space to be in, something that's comparable to Wall Street rather than some back alley market space. Not that it is now, but we were before compared to Wall Street. Now we're, coming up to the same levels as Wall Street slowly. However, this isn't necessarily such bad news for the industry. Many see this as a positive step towards global legitimacy of cryptocurrencies, helping the UAE attract institutional players and fintech innovations by providing trust through transparency. As more countries adapt the CAF idea, the days of crypto being a regulatory gray area are fading fast. The UAE's participation puts it at the forefront of global regulatory cooperation in the digital finance era. The UAE should have implemented this since day one, in my point of view, because it genuinely is a hotspot for crypto criminals. Now, Morgan Stanley is who we're going to talk about next. Remember what I told you? I had two reports. One from essentially BlackRock is essentially moving some assets around, capping their Bitcoin and buying more gold. The other report I told you was regarding Morgan Stanley. Morgan Stanley has came out and confirmed that Bitcoin is no longer the golden goose as everybody thought it was, and essentially said that if you want to go for gold, just go for gold, not the digital gold. So here's inflation. The most prominent banks on Wall Street has essentially picked gold instead of Bitcoin while recommending an inflation-resistant essential portfolio strategy recently. A 60-20-20 portfolio strategy with 20% allocation to gold is currently a more resilient inflation hedge, while US equities are offering historically low upsides over treasuries and investors are demanding higher yields for long-term bonds. The bank's chief investment officer, Mike Wilson, recently said, Bitcoin is often essentially described as a hard asset because the supply is capped at 21 million tokens, making it essentially scarce like gold. Many investors call it digital gold for its potential roles as inflation hedge and a store of value. The 60-40 portfolio generally recommends allocations of 60% to funds like stocks and 40% to fixed income. The assumption is that while stocks, essentially will rally during essentially bullish market turns, bonds will rise during essentially turbulence in the market space. And this way, one asset class often essentially offsets the downtick witnessed essentially in other classes. Wilson offered a different portfolio strategy, as per which 60% of funds are allocated to stocks and 20% each to fixed income gold. He added, gold is now the anti-fragile asset to own, rather than treasuries. High-quality equities and gold are the best hedges. While equities are essentially risk-on investments for growth, gold is safe haven asset during times of crisis. Both assets are hedges against inflation, but during different turns of the market space. After the Liberation Day on April 2nd, when President Trump escalated the global tariff wars, stocks plummeted and have shown remarkable recovery since. As the Federal Reserve announced the rate cuts of 0.25% on September 17th, there has been a further rally. The Nasdaq essentially index rose to 22,768.843 in terms of points, and the S&P 500 index rose to 6,689.60 points. Both indices essentially hitting a new record highs on September 22nd. Gold's spot price also reached a new record high of $3,738.18 per an ounce on the day. However, Wilson didn't recommend Bitcoin as an inflation hedge at all in his report. While the crypto market is getting increasingly tied to the macroeconomic trends, it seems that it's still far removed from other traditional investments like gold in reacting to those trends. An inflation essentially hedge and an investment that seeks to help the investors offset potential losses aimed at inflation when the purchasing power of money declines. Investors genuinely turn to gold as inflation hedge amidst uncertainties inside the market space, as they trust the bullion to show resilience during such circumstances. Crypto enthusiasts have long claimed that Bitcoin's limited supply makes it scarce asset like gold. They also call it digital gold, and it essentially argue it can similarly be invested as essentially as a hedge against inflation. Now, I just want to clarify something. Not everybody inside the crypto space calls Bitcoin a digital gold in any sort of way. Just Bitcoin maxes and essentially Michael Saylor, to be fairly honest, they call it digital gold. Not everybody calls Bitcoin digital gold inside the crypto space in any sort of way. Let's compare essentially the price trajectory, for example, Morgan Stanley's report. Of the two assets over the last year, while gold's price has rallied 40% during the period, this is the funny part, Bitcoin's price has rallied nearly 80%. So that would seem good. Bitcoin has rallied 80% so far. Gold has only rallied 40%. So that means Bitcoin is better. Well, not how essentially they see it. Why the Morgan Stanley CIO preferred gold over Bitcoin as an inflation hedge, despite the metrics, can be explained by a few factors. One, gold is an old store of value, well trusted by a large number of people across the globe. Bitcoin is relatively a novel asset, and its highly technical nature still makes it inaccessible for a lot of investors. Two, gold has shown to be far more stable than Bitcoin, even though Bitcoin essentially, they're saying, even though Bitcoin rallied 80% and only gold rallied up to 40%, but they're still saying that essentially too, gold has shown to be far more stable than Bitcoin. In fact, the latter is known to be notoriously a volatile asset. Three, gold is legal to buy and own in all countries, but Bitcoin ambiguous regulatory status across different jurisdictions doesn't make it an easy investment choice. Even though Bitcoin did better, but they're still saying gold is better than Bitcoin, than the digital gold everybody's claiming it to be. And they're basing their answer on how it reacts inside the market space. Yes, Bitcoin did more within that time frame. They're saying, no doubt about it, Bitcoin did a lot more in terms of percentage, in terms of profits within that time frame. But they're saying, how did Bitcoin get to that price point and how did gold get to that price point is the interesting part. Where when the market was uncertain, gold rose. When two countries went to war, gold rose. When inflation went through the roof, gold rose. Now the opposite. When uncertainty was created inside the market space, Bitcoin went down. When two countries went to war, Bitcoin went down. When inflation rose, Bitcoin went down. That's the difference. They're saying, don't look at it as Bitcoin essentially did 80% and gold only did 40%. They're saying, look at how they got to those percentages. Where gold shows it's more stable. It reacts the correct way when the market is uncertain. Gold acts the correct way when two countries go to war. Gold acts the correct way when inflation is going through the roof. While as Bitcoin is like this, when two countries go to war, it's up, down, up, down. Or essentially the macroeconomic factors, up, down, up, down. That is what they're trying to explain to everyone. So they fully understand. Before any Bitcoin maxes come out and say, well, Bitcoin did more in percentage. Yes. They're saying, yes, it did. But they're saying, look at how it got there. So who is really the most stable asset, Bitcoin or gold? Now, Ripple is what we're going to talk about next on tonight's live, which is Ripple unveils the institutional focused roadmap for the XRP ledger with native lending protocol and ZKP features. Ripple on their website today released a roadmap of what's to come next. Now I have, in bullet points, their roadmap to share with you. And they have a big future ahead of themselves. Before we talk about that, let's go inside the comment section first. Let's see what's happening inside the comment section first, and then we'll go straight into Ripple news. See where we're at. Good evening, everyone. Dennis, good to see you as well. Denise, good to see you as well. How you doing? How you been, Denise? But if you tax registers in Dubai, then no problem. I agree. Hi, Miles and CMF. Stormy, good to see you as well. How you doing? I'm always said there is no country left joined to international tax frame. No UAE, no Portugal, no Dubai. All is an illusion. Let's go, Cali. Now, Ripple. Ripple unveils institutional focus roadmap for the XRP ledger. It was on their website today. Ripple unveiled a roadmap for the XRP ledger today that introduces protocol-level lending, zero knowledge, privacy features, and expanded tokenization standard. The roadmap centers on three core announcements, essentially. One, a native lending protocol scheduled for version 3.0, confidential multi-purpose tokens, and arriving in the first quarter of next year. The immediate availability of the essentially compliance tools include credentials, deep freeze, and transaction simulation essentially capabilities. The features that Ripple is about to be offering through the XRP ledger, essentially, is features that institutions and banks and governments want, which you can tell which angle Ripple has always been going towards. Ripple has always been on the side of advancing governments, advancing institutions, advancing banks in this blockchain sector. And you can tell that by their recent roadmap that was released today. Because the features they're offering, it's everything governments, banks, and institutions want. The native lending protocol will enable pooled lending and unwritten essentially credit to be directly executed at the ledger level through a single asset vault, which essentially aggregate liquidity and issue transferable or vault essentially shares. The system automates loan lifecycle management, including issuance, repayment tracking, and reconciliation while maintaining an off-chain risk assessment where institutions operate established models. XRP Ledger's Zero Knowledge Proof, the ZKP, implementation represents the roadmap's privacy initiative. Confidential multi-purpose tokens scheduled for the release next year. While support privacy preserving collateral management while maintaining the compliance and essentially audibility standards required by regulated institutions. The ZKP integration will enable proving essentially KYC compliance without revealing personal data, allowing auditors to verify activity while protecting essentially counterparty transaction data and supporting proof of reserves without disclosing sensitive wallet information. So on Ripple's essentially XRP ledger, essentially, you can conduct transactions as an institution, as a bank, as a government, and privacy will be there. So that nobody else can see your wallet, so nobody else can see your payments. However, it's privacy with the idea of centralization so that obviously it's not used for illicit activities in terms of funding. These capabilities address institutional requirements for confidential yet compliant on-chain operations. The roadmap also essentially introduced the multi-purpose token, the MPT, standard, launching in October, which enables complex financial instruments to carry essential metadata, including maturity dates, trenches, and transfer restrictions without requiring smart contracts. The Ethereum, essentially, the biggest selling point for Ethereum has always been smart contracts. Ripple's offering something that they can do without essentially the hassle of smart contracts. Essentially, the MPT allows bond, money market funds, and structured products to be represented and traded natively on the XRP ledger with full DEX integration planned for seamless trading and AMM liquidity pools. The roadmap also essentially mentioned three features to expand institutional adoption and capabilities. The first is credentials linked to decentralized identifiers, which essentially enable trusted essentially issuers to assess KYC status and regulatory permissions, which is what banks, institutions, and governments, again, love, the idea of identity on the blockchain. The second is deep freeze, allowing token issuers to halt transfers from flagged addresses until trust lines are unfrozen, providing critical sanctions and compliance tools. For example, if there is a wallet out there that has been previously used for illicit activities, it will be flagged, and essentially tokens will be freezed until the transactions being sent to it. It can also prevent you from sending crypto to scammers. So if you think about this. The last essentially is which lets developers test transactions before network commitment, reducing enterprise risk or high-value operations. The roadmap also introduced permission domains and permission essentially DEX features, which are currently undergoing validator voting right now. These tools create gated participation based on credential verifications of preserving the XRP ledger's decentralized exchange efficiency. According to the announcement, the modular compliance stack enables institutions to define participation requirements and ensures privacy essentially through the selective credentials and disclosures, and leverage essentially order book-based trading with full essentially AML and KYC controls. The roadmap goal is to position XRP ledger and its native asset XRP and RLUSD to service institutional stablecoin payments, collateralized lending, and tokenized assets trading natively at the protocol essentially layer. Version 3.0 represents the convergence of lending, tokenization, permission markets, and privacy features into essentially into a comprehensive institutional DeFi platform. Ripple is about to be opening the doors or expanding even further into the institutional sector because they're listening to the institutions, they're listening to the banks, and they're listening to the governments. And they are genuinely building the future of essentially finance. And as I've said previously, when it comes to finance, it's the #1 project. There is no other project out there that is better than XRP or the XRP ledger in terms of finance. And with Ripple's newest roadmap that came out today and what their vision is going ahead, which is fully towards institutions, banks, and governments, and they're listening to them, they're listening to what they want, and providing that service for them, they're expanding their footprint even more. On that note, we have reached the endings of tonight's live. This was episode 377 of the CMF Live. If you're watching us for the first time ever, the CMF stands for Crypto Miles Family. My name is Miles, and you can tune to this live Monday to Friday, 10 p.m. London time onwards. Now, before we go, obviously, let's go to the comment section first. And honestly, thank you so much to everybody who has liked and retweeted this live right now. Let's see what's happening in the comment section before we do go. Obviously, I feel that Dubai stepping up to be a part of the taxation program to catch scammers also helps either their reputation as a country since their bad situation recently that perhaps these crazy parties were held by crypto money bros clean out the garbage souls, not just tax issues. I agree 100% with Pisces facts. Right, let's go. More bullish news. Let's go. Shelly, Night, Miles, and CMF. Pablo, see you tomorrow, same time as usual. Good night, Miles, and all the CMF. Thank you for the great live and news. Let's go, JP. See you tomorrow, but same time as usual. On tonight's episode of CMF, we talked about essentially Ripple's footprint expanding inside the financial sector even further. We talked about essentially on tonight's live regarding Morgan Stanley's newest report on Bitcoin. Is it really digital gold? We talked about the UAE joining the taxation, essentially joining the rest of the world in terms of taxation of cryptocurrencies and stopping scammers from fleeing to Dubai to use their crypto money. We talked about essentially US lawmakers pushing the SEC to enforce the idea of opening the 401k doors, which is about a $12.5 trillion market space towards crypto sector. We talked about tonight's live also regarding the US and the UK coming together and introducing their new plan that came out today. We went through news regarding Bitcoin essentially and gold, another essential report from a BlackRock perspective. We also talked about tonight's live regarding China essentially pushing to suspend real-world tokenization of assets just for the time being through Hong Kong only. We also went through news on tonight's live regarding the Democratic Party backing essentially the market structure bill for cryptocurrencies. We have enough essentially Republicans and now Democrats to pass anything for the crypto space. We also talked about tonight's live regarding the critical statements from the Fed member Bostic on regarding what's going to be happening further on what perspectives going to get out of the Fed. We also talked about a public company who decided to change its name to AVAX One from essentially Arch Force and essentially invest up to $550 million. We talked about Michael Saylor essentially expanding into the Bitcoin space even more with a $96 million purchase. We talked about Deutsche Bank talking about what the future is going to be like in 2030 in terms of the blockchain space. Also, we went through news regarding the Federal Reserve in terms of removing a certain thing from the Genius Act. So those were all the news essentially we talked about on tonight's live show. This was episode 377 of the CMF Live. Episode 378 will be tomorrow, as usual, 10 p.m. London time onwards. Let's go to the comment section. Obviously, before we do leave, let's see what's happening there. Good night, Miles on CMF. Thank you for a great live with news. JP, let's go. See you tomorrow at the same time as usual. Thanks, Miles. Have a great night and see you tomorrow, same time. Autistic, see you tomorrow, same time as usual as well. Thanks, Miles. Stay bullish, my friend. Let's go. Peg, facts. Everybody stay bullish. Good night, Miles. See you tomorrow night. See you tomorrow night, funky brother. Can you call me after live, brother? Won't take long. No problem. Come on, I'll give you a call after the live. Hi, Miles. Sorry I'm late. It was Frankie's birthday. Problem. Paul, Frankie, happy birthday. Thanks, Miles. Good night, all. Stormy, good to see you as well. How you doing? Stormy, see you tomorrow, same time as usual. Good night, Miles and CMF. See you tomorrow. Mike, see you tomorrow, at the same time as usual. JP, see you tomorrow, same time as usual. Miles, how long will these markets stay down? Not that long. The more the house wins, the more the house is going to be paying out later on. Good night, Miles and CMF family. Have a great night. Let's go, Connors. See you tomorrow, same time as usual as well. Great live, Miles. Let's go, Peg. Thank you so much. And see you tomorrow, same time as usual. Thank you, Miles, for keeping us informed. Let's go, Susie. See you tomorrow, same time as usual. I will see everybody tomorrow, same timing as usual, 10 p.m. London time onwards for the next episode of the CMF Live, episode 378. This was CMF Live. This is essentially the good night, Miles. Bless, mate. Let's go. Can I see you tomorrow, same time as usual as well. The disclaimer of this live, as always, is not financial advice, not political advice, and whatever I say is only for entertainment purposes. I'll see everybody tomorrow. Everybody have a great day or good night, depending on where you're around the world, CMF. I love you all. Thank you so much to everybody who retweeted and liked these live shows and every other live as well. See everybody tomorrow, same time as usual. Love you all. Good night, Miles and family. Great live. Many years. See you tomorrow. Let's see you tomorrow as well here. See everybody tomorrow, same time as usual.